Welcome back to the Deep Dive. We're the show that digs through the noise to find the signal, turning stacks of info into those real aha moments for you.
That's the goal.
And today, we're tackling something big. The idea that the really huge profits in the stock market, they're not just random luck.
Not at all. There's often a powerful force at play, sometimes hidden, but definitely there.
We're going to give you a blueprint, basically, for understanding a pretty sophisticated way to approach the markets.
That's right. We're diving deep into what's called the Tailwind Strategy. It's a very systematic method.
Systematic how?
It's designed to help you align your capital, your investments, with where the world's biggest financial players, the institutions, are already placing their massive bets.
Okay, so riding the coattails of the giants, but in a structured way, not just guessing.
Exactly. It takes the guesswork out. And this approach, it really builds on the work of a couple of market legends.
Right, you have William J. O'Neill, who was famous for quantifying just how important industry groups are.
Absolutely. His research was foundational. And then Mark Minervini, who took a lot of those principles and refined them into a really actionable trading system he calls SEPI.
SEP. Okay, so our mission today is really to lay out this blueprint for you to help turn stock picking from, maybe a game of chance into something more like a rules-based business plan. Where do we even start?
Well, you have to start with the foundation. And that comes from William O'Neill's work, his really exhaustive studies of the biggest winning stocks throughout history.
And this wasn't just theory, right? This was based on hard data.
Cold, hard data. He looked at what actually worked. And his big breakthrough, the thing most people miss. It's quite profound.
Okay, what is it?
He showed empirically that almost half of a stock's potential price movement is influenced before you even look at the specific company details.
Half. How does that break down?
Around 37% comes directly from the strength of its specific industry group, and another 12% from its broader sector. That's huge, almost 50%.
Wow. So the environment matters a lot.
Massively. Think of it like a tide. A strong tide in a hot sector lifts all the boats, even the okay ones. But a strong undertow in a weak sector, it can pull down even really good companies.
So the first job isn't finding the best company necessarily.
It's finding the best environment, the strongest current. That's where your capital has the best chance to really move.
Okay, that makes sense. So who's creating these powerful currents? It's not individual investors like us, right?
No, definitely not. We're talking about the institutions, mutual funds, hedge funds, pension funds, the players managing trillions of dollars.
Trillions. And when they decide to move into an area, say, AI or clean energy.
They don't just nibble, they deploy billions. But they can't just hit the buy button all at once.
Right, that would send the price rocketing instantly, wouldn't it? They'd spoil their own entry.
Precisely. So they have to be stealthy. This large-scale buying, what we call institutional accumulation, happens methodically.
How does that look? What's the footprint they leave on a chart?
They buy large blocks of shares, often over weeks or even months. And this leaves a very distinct pattern, often called an accumulation area or a base.
A base. What does that look like visually?
You'll see sideways price movement, consolidation. The stock price hits a certain level and just stops falling. It finds support repeatedly.
Okay.
And the volume during this period is often above average, but not, explosive. It's just steady buying, absorbing shares.
So this quiet buying, this consolidation, that's building the potential energy.
Exactly. It builds the cause for the future effect, the future price advance. It's like laying the foundation before you build the skyscraper, or packing the gunpowder before the explosion.
Love that analogy. So O'Neill saw this. Institutional sponsorship is the eye in his can slim method, right?
That's it. But it's not just any institutional ownership.
You want the smart money.
You want high-quality institutions, funds with strong track records. Their presence is a massive vote of confidence, like getting the top experts to endorse your project.
So how do you actually see this? Is there a tool for tracking this accumulation?
Yes, and it's incredibly valuable. Investors Business Daily, IBD, they developed a proprietary rating called the Accumulation Distribution Rating, or ACDIS for short.
ACDIS, what does it measure?
It tracks the net institutional buying versus selling over the prior 13 weeks. It gives a simple grade, A through E.
A is good, E is bad.
A is heavy accumulation, B is moderate accumulation, E is heavy distribution or selling. You really want to see an A or a B rating as confirmation.
Okay. So for you listening, the takeaway is Find the sectors and industry groups where the big money, the AB-rated institutions, are placing their bets, and then drill down to find their main targets.
That's the starting point.
Mhm.
Know where the tide is flowing strongest.
Right. So we understand the why sector strength is almost half the battle and the who the institutions. But how do we actually do this mapping? What are the practical steps for you to find these strong currents?
Good question. This is where we move from the broad concept to a practical top-down framework. We combine some economic context with hard data.
Okay, method one is the classic sector rotation model. Now, I know this is more about context, like a hypothesis generator, not a precise timing tool.
That's exactly right. It's about forming a hypothesis. The model suggests that different sectors tend to lead during different phases of the economic cycle,
And the market anticipates these shifts.
often by 3 to 6 months, yeah. So, for example, coming out of a recession, when the market might be bottoming, you often see technology and consumer discretionary stocks start to lead. Investors are looking ahead to recovery.
And later in the cycle.
Late in the recovery, maybe growth is slowing, rates might be rising. You often see defensive sectors like energy, utilities, consumer staples take over leadership.
But, and this is important for you to remember, it's not a perfect predictor.
Definitely not. Studies have shown that just blindly rotating using ETFs based on this model often underperforms buying and holding. The market's usually ahead of the game.
So it gives you ideas, a framework, but you need something more objective to confirm it.
Precisely. We need a validation tool. And that brings us to quantitative relative strength analysis.
RS. RS. Now, clarify this. This is not the RSI indicator, the relative strength index, right?
Correct. Very important distinction. RSI is a momentum oscillator measuring speed and change of price movements for one stock. Relative strength, RS, is a direct comparison. How is this stock or this sector performing relative to a benchmark, usually the S&P 500?
Okay, so it's stock A versus the market. How do we use it practically?
Right.
Ratio charts.
Exactly. You take a sector ETF, like XLK for technology, and divide its price by the SPY, the S&P 500 ETF. You chart that ratio.
And if the line on that ratio chart is going up?
Tech is outperforming the market. If it's going down, tech is underperforming. It's simple visual objective.
So you'd compare all the main sectors this way?
Yes, compare all 11 GICS sector ratio charts. Rank them. Then you focus your attention only on the top 2 or 3 strongest sectors showing clear outperformance. It cuts through the noise.
That makes sense. Removes the guesswork. And then there's an even more granular tool, the IBD industry group rankings. This sounds like a real professional shortcut.
It really is. IBD tracks and ranks 197 specific industry groups, from number 1, the best, down to 197, the worst, based purely on their 6-month price performance.
197 groups. That's way more specific than just technology.
Oh, yeah. You get things like semiconductor equipment or computer software enterprise or retail specialty. Incredible granularity. And it's updated daily.
So it instantly points you to the hottest areas.
Instantly. You focus on the groups ranked, say, in the top 20 or 30. That's where the vast majority of leading stocks will emerge. It's an incredibly efficient filter.
Okay, so using this multi-layered approach economic cycle hypothesis, validated by relative strength ratio charts, and then refined by the IBD group rankings, gives you a really robust way to pinpoint where the institutional money is flowing.
That's the goal. Find the strongest pockets of the market.
So we've found the strong neighborhoods, the top sectors, and industry groups. Now, how do we find the absolute best houses on the block? The specific stocks poised for, as you say, super performance.
Right, because just buying anything in a hot group isn't the path to outsized gains. Now we shift from the macro view down to the micro individual stock selection.
And this is where O'Neill's CanSlim comes back in, but as a filter for individual stocks.
Exactly. It's a rigorous 7-point checklist. Not just suggestions, but specific criteria learned from studying past market winners.
Let's hit some highlights for you listening. What are the key things CanSlim looks for?
Okay, C is for current quarterly earnings per share. You want a significant jump, ideally 25% or more. Shows recent momentum.
Okay.
A is for annual earnings growth. Looking for a strong track record, maybe 25% plus over the last 3 to 5 years. Consistency.
Makes sense.
N is for new products, new services, new management, maybe a new industry condition. And critically, this is often accompanied by the stock hitting a new 52-week high price. That's often a catalyst.
New highs aren't scary then, they're often bullish.
In this system, yes. Leaders lead, they make new highs. Okay, S is supply and demand. Fewer shares available, smaller float, combined with huge institutional demand can create explosive moves.
Yeah, basic economics.
Pretty much. L is later or laggard. You must focus on the leading stocks within those leading industry groups. IBD has a relative strength rating for individual stocks, too. You want that ideally 85 or higher.
85 plus, okay.
IDD is institutional sponsorship, which we talked about, increasing ownership by high-quality funds.
Right.
And finally, M is market direction. This is crucial. The overall market needs to be in a confirmed uptrend because, 3 out of 4 stocks just follow the general market trend.
So even the best stock can struggle in a bear market.
Absolutely. You need the wind at your back.
Now, Mark Minervini built on O'Neill's work with his SEP approach specific entry point analysis. You mentioned it is focused on super performance and low-risk entries, but he starts with something called the trend template. What is that? Why is it non-negotiable?
The trend template is like the first gatekeeper. It's an absolute must-pass technical screen. A stock has to meet all 8 criteria before you even think about looking at its fundamentals or anything else.
8 criteria, wow.
Yeah, it basically operationalizes O'Neill's L for leader and M for market into a hard quantitative filter. And the key thing, it eliminates something like 99% of all stocks right away.
99%. So it saves you a massive amount of time and focuses you only on stocks already acting like leaders.
That's exactly the point. Huge efficiency gain.
So give us a couple of those key trend template rules. What does it look for?
Okay, a big one is the moving averages. The current stock price must be above both its 150-day and 200-day simple moving averages.
Showing a long-term uptrend.
Right. And then the 50-day moving average must also be above both the 150-day and 200-day moving averages.
That's the stacking you mentioned, short-term momentum confirming the long-term trend.
Precisely. It shows a healthy, established uptrend with strong institutional support. Another rule, the current price must be within, say, 25% of its 52-week high. True leaders aren't usually down 50% from their peak.
They stay near the highs.
Exactly. And it incorporates the IBD relative strength rating too needs to be at least 70, but preferably 80 or higher.
So you run stocks through this trend template first.
Yes. Technical screen first. Find the stocks already behaving correctly.
And then you apply the fundamental checks like can slim.
That's the fusion.
Yeah.
Technicals tell you what is happening. Fundamentals help explain why. Screening technically first dramatically increases your probability of finding a winner. You're fishing in a much richer pond.
Okay, so we found a strong sector, a strong industry group, and a stock that passes the trend template and maybe has strong can slim characteristics. We found the what, now the when. Timing the entry. You said this is critical.
Absolutely critical. You can find the perfect stock, but if you buy it at the wrong time, maybe just as it's starting a correction, you can face quick losses. The goal isn't to catch the absolute bottom tick.
What is the goal then?
To buy at a point of minimum risk, just as the stock is poised for an immediate potential advance, a low-risk entry point.
And this brings us back to Minervini and his key observation, the volatility contraction pattern, VCP. Describe that again for us, visually on a chart.
Okay, imagine a stock that's been moving sideways, consolidating after a run-up. The VCP is when you see the pullbacks, the little dips within that consolidation, getting progressively shallower from left to right.
Tighter and tighter swings.
Exactly. Yeah. Each pullback is smaller than the last. And crucially, the trading volume tends to dry up significantly on each of those pullbacks, especially the last 1 or 2.
So less volatility and less selling pressure. What does that signify?
It visually represents the exhaustion of sellers. The supply of stock available for sale at those prices is dwindling. Institutions have likely finished their quiet accumulation. The stock is wound up like a spring, ready to move sharply on any increase in demand.
It's like the market holding its breath before a big move.
That's a great way to put it.
Yeah.
And this VCP structure often appears within classic chart patterns.
Like what?
Well, the cup with handle is probably the most famous. The cup is the larger initial correction, maybe several weeks or months. The handle is that final tight consolidation, usually just a week or 2, right near the old high. That handle is the VCP. Volume dries up in the handle.
And then the breakout.
Hopefully. Another one is a flat base. This forms after a stock has already had a strong run-up. It then moves sideways in a tight channel, maybe correcting only 10–15%. Volatility contracts horizontally. And then there's a rarer but very powerful one called a power play, or sometimes a high-tight flag. This happens after a stock has an explosive move, like more than 100% gain in under 8 weeks. Then it consolidates sideways very tightly, maybe only a 10–25% deep correction. Immense demand.
So you see one of these patterns, the VCP is clear, volume is drying up. When do you actually buy? What's the trigger?
The trigger is the pivot point. This is typically the high point of that final tightest contraction within the handle or the base. When the stock price breaks decisively above that pivot point, that's the entry signal.
But not just any breakout, right? Volume is key here, too.
Absolutely non-negotiable. The breakout must occur on a huge surge in volume, ideally at least 50% above the stock's average daily volume over the last 50 days.
Why so important?
That massive volume confirms that institutions are driving the move. It's not just a few small traders pushing it up, it's real buying power coming in. It validates the breakout.
Any timing tips for entering the trade?
Yeah, many pros actually prefer to wait until near the end of the trading day to enter,
Why is that?
to see if the stock can actually hold above the pivot point and close strong. With that high volume confirming into the close, it reduces the chance of getting caught in a head fake or intraday reversal.
Okay, so you buy the breakout. What happens next? I often see stocks pull back to that breakout level shortly after. Is that bad?
No, actually, that's very common and often healthy. It's called a retest. The old resistance level at the pivot point often becomes new support.
Ah, so it's expected.
An experienced trader anticipates it and isn't shaken out. An amateur might panic sell right at the new support level. You have to factor this potential retest into where you place your initial stop loss. Give the trade a little room to breathe.
This really highlights the need for, well, patience to wait for the setup, and then precision in executing only when everything lines up: the pattern, the pivot, the volume.
You nailed it. Patience and precision. That's often the hardest part. Resisting the urge to jump in too early or chase a stock that hasn't properly set up. Discipline is key.
Okay, this all sounds great in theory, but for you listening, how do you actually put this into practice day to day? We need tools, right?
Absolutely. Trying to do this manually across thousands of stocks would be impossible. Modern technology, specifically stock screeners, is essential.
Screeners, they filter the market based on criteria we set.
Exactly. They automate the process of finding stocks that meet specific fundamental and technical criteria, narrowing down the universe from thousands to maybe a few dozen or even less that deserve closer inspection. Indispensable.
What are some good screeners people can look at?
Well, FinViz is a really popular one, especially the free version. It's very visual, powerful filters. TradingView is excellent for charting, very customizable, and you can even write your own screening scripts if you're technically inclined.
And for more specialized data?
Then you have platforms like DeepView or MarketSmith, which are subscription-based. They integrate IBD's proprietary data like the RS rating, the industry group rank, the Actis rating directly into the screener and charts. They often have pre-built screens designed specifically for Slim or Minervini style strategies.
So let's give you a practical example. If you were setting up a basic screen, maybe on something like FinViz, what key filters might you use to start finding potential candidates based on what we've discussed?
Okay, a basic starting screen might include market cap over, say, $300 million, just to filter out the very small, illiquid stocks.
Makes sense.
Fundamentally, you'd want EPS growth, quarter over quarter, maybe greater than plus 25%, looking for that C from Slim.
Got it. Recent earnings pop?
Technically, you'd screen for price above the 200-day moving average and the 50-day moving average above the 200-day moving average, that core trend structure.
Is stacking.
Right. And you'd add a filter for price being within 0.25% of the 52-week high to focus on those leaders near their peak performance zone.
So even a few simple filters start to narrow the field significantly.
Dramatically. But the screener only gives you the candidates. The real work starts after that.
Right. The tools are just the start. You mentioned Mark Minervini emphasizes a disciplined routine. It's not just about the trades, but the process, developing an intimate feel for the market.
Yes, success really comes from that consistent daily and weekly routine. It's how you stay tuned in.
What does that routine typically involve?
First, you generate your candidates, maybe running your screens nightly or over the weekend. Then comes the crucial part, manual chart review.
Looking at every single chart the screener spits out.
Every single one. This is non-negotiable.
Yeah.
You're visually inspecting for those proper basing patterns, looking for VCP characteristics. The screener finds stocks in uptrends, but you need to find the ones setting up properly for a low-risk entry.
Okay, so you review the charts, then what?
You build focused watch lists, maybe a tiered system, a buy alert list with stocks that are right at the pivot point, looking ready to break out in the next day or two.
The highest priority.
Exactly. Then maybe a high on deck list, stocks with strong patterns developing, but maybe needing another week or two to tighten up.
Keep a close eye on them.
Right. And then a general watch list for stocks that look interesting fundamentally or technically, but the pattern is still too loose, needs more time to form.
And the final step in the routine, Minervini talks about mental rehearsal.
Yes, this is huge. Before the market opens each day, Review your primary buy alert list. Mentally walk through what you'll do if stock A breaks out. What's your entry? Where's your stop? What if it breaks out and fails? What if the market sells off hard?
Preparing for different scenarios removes the emotion in the moment.
Exactly. It helps ensure you execute your plan with discipline when the pressure's on.
And this whole process, constantly watching the leading stocks, it gives you feedback on the market itself, doesn't it? You mentioned pop and drop.
Yes, that's a critical piece of feedback. If you see numerous well-selected stocks breaking out from good bases, but then immediately failing and reversing the pop and drop, that's a major warning sign.
Even if the main indices look okay.
Especially then. It tells you the underlying health is weak. Institutional support isn't there to sustain the breakouts. It's a signal the market environment is becoming hostile, and you need to be more defensive.
All right, let's talk about defense. Risk management. You said earlier this might be the single biggest difference between amateurs and pros.
Without a doubt, this entire strategy, while aiming for big gains, is fundamentally built on controlling risk first. Capital preservation is paramount.
So how do you implement that? Starts before the trade.
Absolutely. You must define your maximum risk before you even think about hitting the buy button. A key part of this is position sizing.
How much capital to allocate to one trade?
Right. You should never risk more than a small fixed percentage of your total trading capital on any single trade. Professionals typically use 1% to maybe 2.5% maximum.
So even if you have a string of losses, it doesn't wipe you out.
Exactly. It keeps you in the game. Losing is part of trading. Catastrophic losses shouldn't be.
Okay, position size is one thing. Then there's the stop loss itself. Where do you physically place it for these breakout trades?
You place it in a logical technical level that, if breached, clearly invalidates the reason you entered the trade. For a breakout, that might be just below the low of the breakout day, or slightly underneath the pivot point itself.
Close enough to cut losses quickly if wrong, but not so close you get stopped out by normal volatility.
That's the balance. It needs some room to fluctuate. Some traders use the average true range, ATR, to help set the stop distance based on the stock's specific volatility.
Okay, that makes sense. So you've got your initial risk defined and your stop placed. What about managing the trade once it starts working, once it moves in your favor?
This is where pros really differ. Controlling risk doesn't end at the entry. Mark Minervini has what he calls his $1 million statement. Once a trade moves in your favor by an amount equal to your initial risk, what we call a 1R gain, the number one priority becomes protecting your capital. Move your stop loss to your break-even entry price. Now, the worst-case scenario is you get stopped out for no loss, excluding commissions. You've financed the risk.
Protecting the downside. And what about taking profits? Do you just hold on forever?
No, that's another key difference. Amateurs often ride winners all the way up and then all the way back down. Professionals typically sell portions of their position into strength.
Selling while it's still going up strongly.
Yes.
Yeah.
As the stock is making new highs, looking powerful, they might sell maybe a quarter or a third of the position, locking in some profit, then maybe sell more later. It smooths the equity curve and ensures you capture gains.
Interesting. Now, a core part of this strategy seems to be concentrating capital, putting significant money into just a few of the very best ideas rather than diversifying widely across dozens of stocks. That sounds risky to some people.
It is, inherently. That's the concentration risk. If you have 25% of your capital in one stock and it gaps down hard on bad news, that's a major hit. Conventional diversification smooths that out.
So how does this strategy reconcile that concentration risk?
It's managed through two key things we've already discussed. One, ruthless loss cutting. Honoring every single stop loss, no exceptions. Keeping the damage from any single position small. And two, dynamic market exposure. Meaning you aren't always fully invested and concentrated. Your level of investment changes dramatically based on the overall market environment.
So this is the ultimate layer of risk management adapting to the market trend itself.
This is probably the most crucial layer. Your entire posture, your willingness to take risk, how much capital you deploy, it all has to be tied to the health of the general market.
How do you gauge that health? Are there specific signals or models?
There are various models. IBD uses something called the power trend, which looks at key moving averages on the major indices, like the NASDAQ and S&P 500.
Right.
For instance, maybe the index needs its 21-day exponential moving average above its 50-day simple moving average, and the 50-day itself needs to be trending up.
So when those conditions are met, the power trend is active. It's risk on.
Exactly. That's your green light. The market environment is favorable. You can be more aggressive with entries, maybe use larger position sizes within your risk limits, let winners run further.
But what if the market turns? What if a circuit breaker gets hit? Like the index breaks below its 50-day moving average or has a sharp correction, maybe falls 10% or more from a peak.
Then the environment becomes hostile. It's risk-off. The
Hmm.
professional response has to be immediate defense.
What does that look like in practice?
You sell any losing positions immediately. You take profits much more quickly on winners, maybe even sell them all. You drastically reduce your position sizes on any new trades, or maybe stop initiating new trades altogether. You raise significant cash.
So the primary goal shifts completely.
Completely, from profit maximization to capital preservation. Protect your assets, survive the downturn.
That adaptability seems key. It's not just about picking stocks, but knowing when to be heavily involved and when to sit on the sidelines.
It's the ultimate risk control. By preserving your capital during those inevitable market corrections or bear markets, you ensure you have the firepower, the ammunition, ready to deploy aggressively when the next confirmed uptrend begins and new leadership emerges. You survive to fight another day and profit.
So wrapping this all up, as you've heard, this tailwind strategy isn't just one technique. It's really a complete integrated system.
That's right. It flows logically from the macro understanding, sector strength, and institutional flow down to the micro selecting individual leading stocks based on strict criteria.
And then back again with that crucial layer of risk management and market timing governing everything.
And if you want to really master this kind of approach, it boils down to three essential pillars.
Which are?
First, you need a statistical edge. That comes from focusing only on the strongest stocks and the strongest groups, playing the probabilities. Second, superior risk management. That means ruthless loss cutting, intelligent position sizing, and protecting capital above all else.
And the third?
Discipline and patience. Having the discipline to follow your rules, even when it's emotionally difficult, and the patience to wait for those high-probability A-plus setups to form, resisting the temptation to trade constantly.
It's definitely not a simple path and certainly no guarantees in the market, but it does offer a proven framework, a blueprint for anyone willing to put in the serious work and develop that discipline.
Absolutely. It's a performance-based approach that demands dedication.
So we've given you the blueprint for how professionals try to identify and ride that institutional money flow. The final thought for you is, what steps will you take this week just to start observing the tide to see which sectors or groups are showing that relative strength in the market around you?